What's up, everybody? My name is Joe Brown. This is Heresy Financial, and Jerome Powell announced that the Federal Reserve will discuss tapering their asset purchases faster than their originally announced $15 billion per month, and they're going to start discussing that at their December meeting. So in this video, we are going to talk about what that means and what implications that might have on the market. Ready? Let's dive in. All right, guys, so you can see here, Powell was speaking before a Senate panel, and he said that tapering could wrap up a few months sooner than anticipated. Now, why is this? Well, the reason is, frankly, because inflation has surprised them. Now, they were anticipating some amount of inflation because they kept on saying that inflation was going to be transitory, and the fact that that's what they've been verbally saying that they've been attempting to do for, 15 years now, maybe longer, is trying to get inflation higher. They were targeting that 2%. They've always said, hey, we want it a little bit higher. Well, they got what they were asking for. You can see their balance sheet shot up. And this chart right here is M2 money supply in early 2020. That shot up as well. And so you're going to have the consequence of money printing is inflation. You're going to get inflation when you have that unprecedented level of monetary expansion. Now, in order to deal with the persistent inflation that they never thought, he talked about transitory. So basically they thought that the inflation spike would be temporary, not the price spike, the inflation spike. I've talked about this before, but transitory, they were always referring to the rate of inflation. So if inflation is 5%, 4%, 6%, they were expecting at some point the inflation rate would go back down to 2%. That means they expected prices to jump up initially and then continue increasing at their slower pace as they used to. Well, that hasn't happened. Partly because when you expand the money supply so much, you introduce more problems than just a small price rise. You have such a big demand spike from that that you don't give enough time for production to catch up with the increased demand. That results in bottlenecks, supply chain shortages, and things like regulations requiring certain people to not work certain places, be able to, especially in the transportation industry, people not being able to leave ships and go on land, and people not being able to cross certain borders that are in the transportation industry, shipping industry, have made it all very difficult, and people are leaving those jobs like crazy. And so all of this is contributing to, shortages. So it's basically just supply and demand, right? So you've got money printing causing a spike in demand, and then actual drops in supply as you've got these supply chain bottlenecks and shortages coming up. And so all of that has contributed to much more persistent inflation than they were expecting. And so Powell is saying that they're going to start looking at, in December, adjusting the pace of purchases if warranted by changes in the economic outlook. So if we look back at their balance sheet here, we can see here their balance sheet was relatively steady at around 800, 900 billion or so. After the financial crisis, it shot up. And I made a video about this before, but every time in here, if we zoom in to expand that out a little bit, every time they try to taper their balance sheet and bring that down, you saw a corresponding, not crash, but corresponding drop in the stock market until they backtrack. And so every time they try to flatten out their purchases or reduce their balance sheet, it led to problems, and they eventually had to backtrack. So right now, over the last 15 months, we've been seeing a very steady pace of purchases here at right around $120 billion per month. So now this is going to start flattening out, and as long as all goes according to plan, their balance sheet will get flat. If their purchases approach zero, then this is what their balance sheet would look like. That's a little bit down, but it would basically look flat. And so that's what they're planning on trying to achieve. Their balance sheet not growing, not dropping, that's tapering their asset purchases. And then once that is done, once this is no longer going up or down, then they would look at interest rates. The problem is, look at what's happening with interest rates. So short-term interest rates, this is the 2-year Treasury yield, popped today on this announcement. The dollar volatile today. And then yields of the 10-year, 20-year, and 30-year all dropped, mainly a function of the risk-off attitude. Stock market started dropping because you have such a debt. You have this system. The financial system is built on such a large foundation of debt that if debt starts getting too expensive as a result of a big buyer pulling out of the debt market, well, then you have asset prices have to start repricing downwards. And so the Dow dropped with no rebound. Russell 2000 dropped with a little bit of a rebound. NASDAQ, same thing, just not as much, and the S&P 500 as well. Gold and silver also experienced a significant drop towards the end of the day, even though they were up early in the day, partly because, well, gold specifically reacts mainly to real yields. And so as inflation expectations are taking off, we're seeing pressure on, well, inflation expectations staying elevated. We're seeing pressure on the price of gold here because real yields are not moving further negative. They're reacting to the inflation and to a big buyer pulling out of the markets, especially at the short end of the curve. And so what we're going to see here, if they are able to actually decrease their purchases faster now in anticipation of the sustained inflation, what we're going to see is a taper tantrum far sooner. And we know that in 2018, when Powell first took the helm at the Federal Reserve, we saw he was sticking to his guns and he was tightening, right? And that led to the taper tantrum towards the end of 2018 here, where you saw the market start to sell off and they had to stop raising interest rates. He had to backtrack and reverse course. Now, that is the point at which central banks got the clue that this right here was not temporary, because the Federal Reserve was able to get away with what they had been doing with central banks since the financial crisis, because the rest of the world believed the Fed that it was temporary, that they would wind down their balance sheet at some point. This right here proved that they were never going to be able to do that, and central banks on net started selling treasuries, and now the Federal Reserve owns more treasuries than all central banks combined. But as of yet today, the rest of the world, central banks excluded, institutions, individuals, have not caught on to the fact that this is not temporary, because they've been saying all along that at some point they're going to undo that because of the inflation itself being transitory. Once the markets really start to tank here, once some big financial institution declares bankruptcy or says they're insolvent, once an emerging markets crisis starts to spin out of control, this will resume. So they're going to as far as what they're saying, this is going to start flattening out. So over the next couple of months, as this flattens out and starts to look like this, what we're going to have to see very soon, it's not going to be 4 years like it was last time. We're going to see another spike like this. And that's when a lot of people are going to realize, oh, this isn't temporary. This is going to last forever. They can never unwind their balance sheet. They can never take interest rates to normal levels, because it will collapse the economy, and we are just going to have to choose between a deflationary death spiral or inching closer and closer to hyperinflation. And the inflationary route is what they're going to choose, because when you choose between deflation or inflation, you're choosing a winner and a loser. If you choose inflation, the borrowers are the winners and the lenders are the losers. If you choose deflation, it's the opposite. Well, who are the borrowers? It's all of the biggest corporations and it's the governments, right? And so clearly they're going to choose the route where they end up the winners from that. So this is it's a little bit surprising to me that he's saying that they're going to have to increase the pace at which they're decreasing their asset purchases, and admitting that the word transitory, it's time to retire that, because we might just be in a stage now where these inflation numbers are persisting a lot longer than they expected. And so they're going to start verbalizing their intentions in a different way, probably just trying to confuse people even more. But it's only a matter of time before people realize, hey, the dollar debasement is here to stay. The devaluing of money is here to stay. And the people who are hardest hit by that are lenders, are dollar holders, and people who live on fixed incomes, which includes what you think of pensions, but it includes people who earn wages, who are employees, because by the time wages respond to inflation, it's number one, usually not enough, and number two, usually too late. You've been living on old dollars for a year or 2 years. By the time you get your raise, you're already behind. You're not getting paid enough to make up for everything that you've lost. And if inflation was 6% and you got a 5% raise, well, you're still behind. You got a 1% pay cut there. And that's assuming that the official inflation numbers match your cost of living increase, which most of the time they don't. So that's what we're looking at here. I fully anticipate that the tightening will lead to another taper tantrum like at the end of 2018, right in here. And that will necessitate the Federal Reserve reversing course, blowing up their balance sheet yet again. So that's what I'm looking at here. As always, really appreciate you guys. Thank you so much for watching. Have a great day.